Bloomberg Audio Studios.
Podcasts, radio, news.
This policy was always nonsense. It was never going to accomplish the risk mitigation that was the idea behind it. The idea is, okay, if we make sure that bankers are paid less, they'll take less risk and the financial system will be less dangerous. And it was, no, you give bankers more money, guaranteed, whatever risks they take, and you give more of it to them up front immediately so that they don't have to worry about whether those risks go bad in 2 years' time.
Welcome to the City of London.
The City of London.
The next station is Bank. Please mind the gap between the train and the platform.
The financial heart of the country.
The City.
The City.
Welcome to In the City.
Stand clear of the doors, please.
It's another week and another look at the conversations motivating policymakers and financiers the world over. And I guess arguably nothing motivates a financier more than the question of pay. And we're talking about how the City of London could soon be seeing, yet again, Wall Street-sized payouts coming after the UK lifted the cap on bonuses that's been limiting them ever since the financial crisis. Just a few weeks ago, shareholders at banks, including HSBC and Barclays, waved through proposals to follow through on lifting that cap. So bankers could be looking at bumper payouts next bonus season. So we're going to talk about what all this means for city firms, London's competitiveness, and the broader consequences of overhauling banker pay. I'm David Merritt, back in the London studio and leading this week's In the City. Francine is off in Doha at the Qatar Economic Forum, and Allegra is out on assignment, but I'm not alone. Joining me in the London studio is Bloomberg opinion columnist Paul Davies, who covers banking and finance, and Tom Metcalf, senior editor overseeing our City of London coverage. Welcome back.
Hello. Thank you.
And I seem to remember the three of us all sat down here, I think back in January 2023, talking about this subject of banker bonuses, but it was a bit of a different landscape at the time. We were talking about what a rough year it was going to be. Donuts, is it? Or bagels?
Goose egg, I think, is another one.
At the zero bonus after a pretty dismal year. But things are looking a little different this year, Paul, aren't they, so far?
Yeah, they are. So we've seen a good recovery, particularly in the investment banking side of things, the advisory side of things, not for deals necessarily, but debt capital markets, which is the business of helping companies borrow through bond issuances, and equity capital markets, so IPOs, new listings, secondary offerings of companies that are already listed. Both of those have recovered very strongly. Just some numbers from the first quarter reporting season. The average kind of increase in revenue over the same period last year was 46% for debt capital markets, 76% for equity capital markets, deal making still flat. And that's US and European banks. So there's been a lot of good activity there. And on the trading side, it was still a pretty big year last year for a lot of the fixed income, commodities, currencies trading business. That business has continued to slow into this year from the end of last year. But within that, credit trading, which is trading of corporate bonds, which follows on normally from lots and lots of bond issuance, has been pretty strong. So in all of these areas, as we had a story the other week, I think a lot of bonus payments are going to be going up compared to this time last year.
Yeah, that's the story that caught my eye last week, that bonuses are going to be soaring on the bond desks after the activity really picked up. I think it's one of our most read stories on the Bloomberg terminal last week, not surprisingly, considering
everybody loves to read about their pay.
They all click on that one. It's very clicky. But you talked about the debt issuance makes sense. But on the equity side, we've talked on this podcast a lot about how London's had a really dismal year for IPOs. But is this kind of evened out? This is across the whole of Europe and all around the world, people getting paid for.
Yeah, the numbers I talked about were US and Europe. But US activity has obviously been pretty decent. We've seen a number of quite sizable IPOs, not back to anywhere near the sorts of levels that we would have seen a couple of years ago, or even before the COVID pandemic. But there's been some big deals. Reddit was a big deal that lots of people looked at and did quite well, and a bunch of kind of AI-related businesses as well. The UK still has a bit of a problem with listings. Maybe that will come back.
And the market has obviously been on its head. If you think about the stock market, looking at the new highs in London. I was looking at some of the bank share prices earlier. Barclays is up a lot. HSBC is up a lot. Tom, do the banks in London feel in pretty good health at the moment and ready to pay out more bonuses this year as a result?
I think Barclays is feeling pretty happy, though I think with every bank is a little bit different, right? Barclays is going through this strategic shift. I think a lot of that share price might be more shareholders enjoying that and also looking forward to buybacks or more dividends for them, basically their bonuses, right? But broadly speaking, the investment banks out of Europe came through quite well this quarter, which doesn't always happen.
The interesting thing there is that Barclays is the one that really underperformed, actually, compared to its rival. Deutsche saw really good recovery compared to last year in its trading and its kind of investment banking, and UBS did pretty well as well, although with Credit Suisse being added in and all of the problems that they had there last year, that makes those numbers a little bit tricky. But Barclays really slipped behind its rivals in lots of ways, it seemed, in trading and in investment banking.
We're not even halfway through the year, actually, are we? So are we getting ahead of ourselves here, predicting what these banks are going to do? I mean, there's so much geopolitical tension around the world. There's so much uncertainty economically. Britain's only just emerged from this mild but nevertheless real recession. Could it all go wrong second half of the year?
Yeah, I mean, globally, there's all sorts going on that could knock markets off track. I think one of the things at the start of the year was that everybody was expecting, 5 or 6 interest rate cuts in the US, 3 or 4 in Europe, several in the UK. I can't remember exactly how many.
And we've got none.
And we've got none so far. And the number that we're expecting has also reduced a lot as well. So rates are remaining higher, particularly in the US. Inflation is proving more stubborn. That's already starting to knock what people want to do in debt markets. It's already creating a bit more uncertainty in the minds of, executives and certainly private equity leaders in terms of what they're going to do. And then, of course, there is these terrible geopolitical situations that keep threatening to spill out of control or beyond the locations where they are. And we've got 1 or 2 fairly significant elections coming up later this year, particularly in the US and the UK, obviously, as well, which will create another spell of uncertainty where people just won't want to take big risks or do anything particularly spectacular in markets.
So even if we don't fall off a cliff later this year, in terms of what sort of packages might be on offer, we're not going to go back to the glory days or some of those big bumper years, are we? Things may be up 15, 20% looking at the story, but we're not talking about...
Yeah, I mean, in the areas where you're looking at nice increases in potential bonuses, we're talking about versus a spell last year and the year before where pay was way down and activity was way, way down. And then in terms of like where we're getting back to, the glory days, the days of 2021 when we saw record M&A, record IPOs, there was the whole kind of like SPAC phenomenon that just blew the roof off of all sorts of areas in equity capital markets. Those are long gone. We're not going back to that.
I want to talk about the bonus cap. Okay, so first of all, let's sort of dial it back just to explain why we had this rule imposed. What was the point of it and did it work, Tom? Can you explain?
Yeah, so it comes out of the EU regulation, though it was actually largely UK driven as well, having the City of London such a big thing. But basically, the idea was it would, after the global financial crisis, stop banker excess. And effectively, the rule came down for most investment banks in City of London and the EU still, is you could only have 2 times a bonus of fixed pay. And the complaints that came from the City of London at the time were, wait a minute, this is not conducive to how we like to run our business, which is if you have a great year, yes, bonuses shoot up to many multiples, but in a bad year, that sort of variable comp really falls and then you don't have as much expense lines. That all changed. I think it came in maybe 2014.
So this is George Osborne as Chancellor. This is pre-Brexit.
Yeah, exactly.
So the City of London leading the way, but this is an EU-wide rule change.
Yeah, it was EU-driven, and the UK did, I think, try and push back against it. But yeah, it went through, and now you have this situation where, post-Brexit, the UK has actually rolled back that rule, and what we're seeing now, it obviously takes time to feed through, is all the UK-listed banks have broadly said, okay, we're going to remove this 2-to-1 limit, and it's creating a really interesting dynamic as well, because you've had, say, the Deutsche Bank CFO come out and say, we think this puts us at a competitive disadvantage because for the people we're trying to pay in London, Deutsche Bank still has to abide by the EU laws, I think.
I just on the politics of this then. So it was first announced, lifting the cap was first announced by Kwasi Kwarteng, briefly the Chancellor under Liz Truss, in his notorious so-called mini budget. But then this was one of the policies that he announced that was actually picked up on by Jeremy Hunt, who succeeded him, and has now gone through. As Paul said, we've got an election coming at some point this year. Polls suggest Labour are going to take over. What's their policy on this? Is this cap in danger of being reimposed by Rachel Reeves and Keir Starmer?
I think all logic would say no. It's just because to go back and forth on this doesn't really help anyone.
Unimaginable.
I know, a nice flip-flop. But I think Labour's general sort of posture towards City of London is they're trying to be seen as a safe pair of hands. And frankly, this is one of those things that generates a lot of headlines, but ultimately it doesn't necessarily mean a banker is going away with many more times pay than he's already getting. It's just the risk of that size of that package is much more on him. And it prevents sort of these distortions we saw, because what happens is it didn't result in bankers getting paid less. I think the Bank of England said it resulted in them getting paid more because fixed pay goes up, so you're guaranteed that. And then whether you have a good or bad year, you're still getting a huge amount.
Paco Ibarra, who was the Citigroup's most senior executive outside of the US, or based in London anyway, who I think his fixed pay went up to $8.5 million.
Something like that.
Yeah. Compared to Jane Fraser, his boss, the CEO, whose fixed pay was $1.5 million. Now, don't feel sorry for Jane. I think she gets paid, quite well overall. But it was just... that kind of shows you what happened.
That's really what's the difference between London and Wall Street is Wall Street you can get a relatively small fixed pay, but then many, many multiples. Whereas in London, you would have a huge salary and then a smaller February season.
And so this is what Goldman said earlier this month, right, when they said they're going to change the rule. They're going to lift the cap in London. And they said, this is going to enable us to manage our business better because you don't have to make these big adjustments. It's not like overall people are going to get paid differently in London or New York, but you don't have to suddenly whack up someone's base salary if you're shifting them from Wall Street to London. So it's an accounting thing, really.
It's just simplicity across a whole global firm, right? They don't have people going, I'd love to move to London because I sort of want to have...
it gives banks better control over their own costs, which is the main reason why I think James von Moltke at Deutsche Bank really wants to get it back as well, so that he can control his cost base better. It allows banks to cut pay dramatically more when markets are very weak and activity is very poor, which is good for them. This is why shareholders overwhelmingly, like 99% voted in favour of this at the HSBC and Barclays AGMs as well. The key thing about it is this policy was always sort of nonsense. The Bank of England came out against it at the time, and it was never going to accomplish the risk mitigation that was the idea behind it. The idea is, okay, if we make sure that bankers are paid less, they'll take less risk, and the financial system will be less dangerous. And it was, no, you give bankers more money, guaranteed, whatever risks they take, and you give more of it to them up front immediately so that they don't have to worry about whether those risks go bad in 2 years' time. So this is like a key point of why it was a bad policy in the first place and why, Labour's certainly not going to reverse it because it wouldn't make sense.
It was an eye-catching policy at the time, wasn't it, to try to assuage public anger, really, over the financial crisis, or for governments to point a finger of blame and say it was excessive risk-taking by traders, by bankers, but really just no more than that, really just a political gesture.
Yeah, I think it was good politics and bad policy,
What about the bankers themselves? If you're getting used to your fixed pay, you're not going to want to suddenly take a 90% pay cut, are you? And
I don't know, move to Europe as quickly as possible. Get that trading job in France.
It's another incentive, is it, do you think, for them all to relocate?
Imagine how complex this is going to be for banks to unwind. They've got all these contracts out there. When I speak to some executives, they were, this was not top of their sort of to-do list, at least for UK banks, just because it's such a sort of administrative hassle. But I do actually think among the rank and file, it will vary massively. If you're a superstar trader, you're going to probably be quite keen to move to the New York model because then your upside is out the window, basically. Thinking
about the competitiveness with Europe, and I know we've talked about this many times in this podcast as well, Tom, but is the Deutsche Bank exec right that this puts Europe at a disadvantage? Is this going to be another reason for London to claw back a bit of its status post-Brexit as the preeminent financial centre in Europe?
I think it's helped, and this seems to be the main thing City of London can do is this stuff. It's not marginal, it is important. Anyone affected by this, it will be a massive change to them. But broadly speaking, it's kind of stuff that will help the pitch. And I think London's obviously always going to be a huge financial centre. I think it is interesting you get these messaging from EU that they are a bit more worried about some of these reforms. But then, you flip it around and people in London are very much looking over at Europe and worried about it. So I don't think there's a kind of clear, this is absolutely going to protect London from any further sort of attrition over to Europe. And you've got Emmanuel Macron in France talking up all things finance, all things business. There's plenty for the EU to go forth.
Is the EU just going to have to follow suit on this and scrap the bonus cap as well? Or?
I mean, I think the banks themselves will be campaigning for it, as Deutsche Bank has come out and said publicly, because they prefer it. It's a better way to manage their own businesses. Beyond that, I think in terms of London versus the rest of Europe, this is a thing that might help stop more bankers going to Europe to some degree at the margin. But in reality, what all the banks, or especially the UK and especially the US banks, have been doing in Europe is get as many people as they need there to meet the ECB's kind of desk mapping and risk management requirements and no more. And they've done quite a lot. They've all got a good few hundred people doing these various things, but they don't want to switch everything over to Europe. London is still the place where they have most connectivity with most of the investors and other companies and clients and that sort of thing.
Yeah, what it would take to shift that again would be some other move by Brussels to force the bank's hands a little bit more. In the heat of the Brexit rows, there was all this talk, wasn't there, about how tough that could get in terms of arresting business. Sounds like what you're saying, Paul, we're at this sort of equilibrium where the banks are just doing enough to satisfy the regulators and yet maintain the majority of their staff here because that's just more efficient. Are we in this kind of equilibrium now where actually the Brexit shakeout has happened and Europe can just go back to work?
I think so. It feels like that. Certainly talking to some of the leaders of the US banks, businesses in Paris and Dublin and places like that recently, they've done a big expansion and then they've hit a kind of a level where they're relatively comfortable. Now, beyond that, it will depend on where the business is. I mean, Goldman's just moved some financial institutions, group bankers over to Paris with people who bank insurance companies and banks and other sorts of things. And that's because they think a new wave of deals and capital issuance and that is coming in Europe from European banks. So, the more that there is activity to serve in Europe, the more they will put people close to that. But beyond that, the regulatory and the economic reasons perhaps for moving people have perhaps sort of, evened out at the moment.
I was just reading this morning a report about activity in the City of London in general. There's been a lot of doom and gloom this year. Terrible year for IPOs, the London market shrinking, British companies giving up on London and going to list in New York. There are a couple of big deals down the pipe which potentially could manifest here. We've seen the government come out with a whole lot of talk around re-incentivizing people to be in London. Are we seeing any green shoots for the London Stock Exchange, for the city as a whole, and for the capital markets here? Or is it still, for the rest of the year, looking a little bleak, Paul?
I'm not seeing any particular green shoots, I don't think. We've got the NatWest share sale coming up, which will maybe gauge something about institutional and retail appetite for owning UK stocks. But beyond that, it's a question of the kinds of companies we have and the kinds of investors we have. There's been a lot of chat around changing listing rules or weakening standards, I should say, improving standards. Shifting standards to encourage different sorts of companies to use the market and so on. And there's also been talk about creating a market for temporary IPOs. I think the London Stock Exchange is leading a kind of an attempt to create a sort of a mini market for temporary IPOs where private companies can have their shares traded and priced briefly to help, employees and early investors sell stock and that sort of thing. But, I think the problems or the sort of the issues are more deep-seated. They're to do with the kinds of companies that the UK has and the kinds of companies that a lot of, UK-based investors want to own, and they seem to want to own kind of income-producing stocks for the large pension schemes, which I think are a lot of the investment money in the UK market.
Big structural problems remain, regardless of...
It's not like Labour will come in and click their fingers and there's this wonderful strategy they have. This is writ large. You see it on the IPO side of things. That is not really a Brexit thing at this point anymore. I think it's just very much these structural things that Paul's pointed out. The London Stock Exchange, they're trying all sorts of things. There's pushes within the City of London saying we need to have a conversation around executive pay, like we need to basically pay executives more in line with the US. But again, all of this stuff will not change those fundamentals. To be honest, the debate should be more around UK productivity. It's probably a multi-year thing they need to look at, but I've got no idea what any solution would be for that. So I do feel sometimes a bit sorry for the London Stock Exchange because it's not like operationally they become 10, 20% worse or anything. It's just...
Yeah, the stock market gets all the headlines, doesn't it? But actually, you're right in terms of FX or the...
Exactly. You've got FX, you've obviously got the debt markets. I had a really interesting conversation with someone in the city saying, basically, to paraphrase, we should just give up on equities. It's all going to end up in Wall Street eventually. And why don't we focus on what has always made London truly great? And it is that sort of, going back to the Eurobonds market, it's that kind of bold bonds, debt, FX for sure, anything very international. And the way London as it presents itself, it is an international financial centre. And I think you can make a very good case for London being the world's best or most attractive international financial centre if they get it all right. But obviously that's easier said than done.
And I guess headlines about flexible banker pay, bumper payouts can't convince people maybe.
I'm sure they can't hurt. And as I was saying before, for the banks themselves, at the margin, it will make them happier to move people from the US to London and happier to keep people in London rather than letting them move to Europe if they want to.
Fantastic. Thank you so much, Tom and Paul.
Thank you.
Thank you.
Thanks for listening to this week's In the City from Bloomberg. This episode was hosted by me, David Merritt. It was produced by Summer Sadi. Show open design and production support from Moses Andam, and Brendan Francis Newnham is our executive producer. Sage Bauman is head of podcasts. Special thanks to Paul J. Davies and Tom Metcalf. Please do subscribe, rate and review wherever you listen to podcasts.